Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. In today's world of markets, few relationships are better studied than the yield spread of risk-free bonds with different maturities. The funds rate versus the 2-year, the 2-year versus the 10-year, the 10-year versus the 30-year, all constitute spreads that market participants find highly instructive in gauging macro variables like growth and inflation. Many academics have contributed to shining a light on the information content of the yield curve, and as a Ph.D. student at the University of Chicago in 1986, Campbell Harvey made one of the earliest and most important contributions. Over the course of his impressive career, Campbell's research interests have been vast, and his curiosity has led him to all corners of finance, including derivatives, emerging markets, the time variation of risk premium, political risk, and how to manage your luck versus skill. Our conversation focuses on his current work as an investment strategy advisor at Man Group, where he has done work on the idea of crisis alpha, strategies that can effectively offset portfolio losses suffered during risk-off events. Campbell and his colleagues find that both time series momentum, as well as a long-short portfolio focused on the quality factor, both have insurance-like characteristics and can be valuable overlays for equity portfolios. He also shares his work on rebalancing, where he sees alpha destruction if done in traditional form, but opportunity for much greater efficiency by incorporating some of the findings on time series momentum. Lastly, we discuss Campbell's new book, DeFi and the Future of Finance. As the title may imply, he's bullish on the breathtaking pace of innovation in the financial services industry. I hope you enjoy this episode of the Alpha Exchange, my conversation with Campbell Harvey. My guest today on the Alpha Exchange is Campbell Harvey. He is a professor of finance at Duke University's Fuqua School of Business, a prominent academician, and also has affiliation with both Man Group as an investment strategy advisor and as a partner at Research Affiliates. Campbell, it's great to have you on the podcast today.
It's great to be on the show.
Excited to have this conversation. It's a one in which it's almost difficult to know where to start. Your resume of publications and awards in the area of academic finances is quite impressive. You're the winner of 2 Best Paper Awards from the Journal of Portfolio Management, and that really just gets it started in terms of the accolades. So you've spent really your career investigating at the highest level some of the really interesting questions in the world of high finance. Tell us just how you got so interested in finance. Tell us about the early days for you as a student, as a Ph.D. student. Why don't we get started there?
Yeah, so let's actually go back even before that. And I was a master's student in Toronto doing a 2 years master's. And in the summer, I took a job. And I had a number of options, but this one sounded really interesting. And I worked in corporate development for the world's, at the time, largest copper mining firm. And I got there and I was tasked with coming up with a forecasting model for GDP growth. And it kind of made sense because copper mining and mining in general is very pro-cyclical. And it's very costly to shut down mines and start mines, and to have some idea of what's going to happen in the economy is really important. So I'm this junior person, summer intern, tasked with a job like this. And it was really energizing. And my idea was, instead of going the usual route where you look at macroeconomic variables to forecast macroeconomic variables, what I wanted to do was to use the information in financial instruments. So you think of a stock, well, that stock, the price today is actually determined by the expectations of the future cash flows. And those future cash flows are very dependent upon the state of the economy. So that's where I started. And I did this initial research looking at the stock market and using it to predict a GDP growth, and it went nowhere. The stock market was just way too volatile. And I kind of realized that, well, the idea is a good idea, but the application to the stock market isn't. So then I decided to look at the bond market. And the bond market had a lot of advantages. For example, there was a fixed maturity in terms of the cash flows, whereas the stock market, who knows what the maturity is? You actually know what the cash flows are from the coupons for a bond, but for equity, you have no idea what the dividend is going to be for the next 10 years. And then the third aspect was important also, and that is that the stock market is volatile and risky, whereas if you're looking at treasury bonds, they're fairly risk-free. So my idea was maybe I could extract information from these bonds. And what I decided to do was to look at the yield curve. And I did that on purpose because I wanted to kind of strip out expected inflation from this and really focus on GDP. And then basically what I did was I discovered in this preliminary work that the slope of the yield curve was really useful in predicting economic growth and recessions. It was preliminary. I hadn't even written it up yet when we got notice that the entire area of corporate development was closed down and I was laid off. And I still had like 3 weeks to go before school started. So I continued to work on that project. And when I got back to start my second year of my master's, I presented the work to some faculty and they were really energized by it. And they did something that I really appreciate. They said, well, there are these 3 courses that are required. Why don't we just do one essay course where you work on this and we'll basically count that towards the 3 courses. So I began to do research and then I polished the paper. I presented it to the faculty. Again, they were very impressed. And then they said, you need to do a Ph.D. And look, I had no idea. Like for me, I was the first person in my family, my direct family, to have a bachelor's degree. And the master's seemed like, well, that's extraordinary. And to go to a Ph.D. So I applied to a number of schools. And in hindsight, I realized the application was a powerful application because I included the paper. So the people reading the application are saying, well, this person actually is doing research already. That's what we want. So I decided on the University of Chicago and went there and almost immediately started working on my paper, put together a really powerful committee to help me. And my committee, when I defended the dissertation, they were a little skeptical because I was predicting like 4 out of 4 recessions. They were impressed. They got the double dip in the early 80s. They were fundamentally impressed that the idea was well-founded in economic theory. So that's very important. So this wasn't necessarily a data mining exercise. And then the third thing that they really liked was the popular way to do economic forecasting at that time was to pay a service, an econometric service that might have thousands of equations and pay them tens of thousands of dollars for their forecasts. Whereas my forecast was basically the cost of a Wall Street Journal at the time, which was like 25 cents. So I did this, and it's weird that so many years later, we're still talking about my dissertation, inverted yield curves predict recessions. And one of the reasons we still talk about it is the following. When you publish research, there's usually 2 things that happen. Number one, the effect gets weaker through time. And that's actually the good scenario. And often the bad scenario occurs where the effect completely goes away. However, with my idea on the inverted yield curve, there were 4 out-of-sample recessions. Each one was preceded by an inverted yield curve. And so far, we haven't had a false signal. And maybe the reason that it's very much in play was that it clearly forecasted the global financial crisis recession. So at that time, the Fed completely ignored the yield curve signal. Indeed, I've got correspondence from somebody that used to work at the Fed, and he was pushing my research to important people at the Fed saying we can't ignore the inverted yield curve. We need to do something about it. And for a year, nothing happened. And that was potentially very costly. So that's my beginning in finance. It's unexpected. Maybe there's some luck involved. But this idea that you can use asset prices to extract expectations is an idea that doesn't go away. And much recent research in finance and economics is really focusing on those expectations.
I suspect that a thread throughout this conversation is going to be the information content of prices and the way in which you can utilize the voting machine that is markets to essentially back out various relationships or expectations, both on an absolute basis or a relative basis. I was hoping just if you could, from that 1986 period and then thinking about the power of this model after that period. So we had a couple of recessions, certainly one in the 90s. We had the tech bust, of course, the global financial crisis. And then I want to say at the early part of 2019, you had a curve inversion as well. And I just remember people clearly must have been dialing you up because you were making plenty of commentary, I think, at that time on the yield curve. So I think folks know who to go to. But just give us some characterization of what we've seen in terms of the yield curve's performance in those periods preceding the recessions after your dissertation.
Yeah, so it's interesting because, like in social media, people are always looking to criticize. And there are a number of people that have criticized my model. And basically, they admit that the signal is very good at being like an advanced indicator. So it inverts a year before the global financial crisis. And they admit that it's pretty good at telling us about the duration of the actual recession. So the number of quarters that you're inverted is very closely aligned to the length of the recession. But then they criticize the model because it's not very good at getting the depth of the recession. So, for example, the global financial crisis recession was one of the deeper recessions, and the model inverted well before the crisis. The length of the inversion was exactly the length of the global financial crisis, but I didn't get the depth. And come on, I get 2 out of 3 with a model that's got a single variable, just like one thing. So it's an incredibly simple model. We know these models are only approximations of reality. And I mentioned earlier these econometric services that might have thousands of variables that they're looking at simultaneously. This is a single variable. And it's what falls out of theory, but the theory is a highly simplified theory. So the bottom line is that this simple model has been useful. Yes, on June 30th, 2019, I went public. The yield curve had officially inverted for a full quarter, and I predicted a recession in 2020. Obviously, the yield curve inversion didn't predict the COVID-19, so that's kind of obvious. But we'll never know the true or the counterfactual. So in 2019, at Duke University, we do a survey of CFOs. It's a large survey, like 400 CFOs. And at the time, more than 50% believed that a recession would begin in 2020. And that went up to 70% if we included the first quarter of 22. So it was a widespread belief. The recovery from the global financial crisis was a record length. And it was widely expected that there would be a downturn. But again, we'll never know. But in the end, the indicator is 8 out of 8. And if I was doing the same exercise today in terms of, build a model to forecast GDP growth, would I use the yield curve measure? Yes. Is it the only thing I would use? Definitely no. So there's other information out there I'd want to look at. But again, it's a very useful indicator. And indeed, I know for sure that it might have had a difference even this time because people were thinking, yield curve's inverted. We need to be careful. in terms of having some cash around, maybe delaying some investment projects, just so if a recession occurs, we stay in business. Well, a recession did occur. And yes, there was a lot of government help. But again, just to be cautious, even before the COVID, I think that risk management played a substantial role.
Well, you have a couple of things there. I mean, first, just with respect to the global financial crisis, this was really a finance event that became an economic event, right? I mean, there was a couple of things there, but the duration and severity of that shock was very much about the financial system being on its knees and then working tirelessly for a couple of years to try to resuscitate that part of it. So that length is, I think, certainly a unique part. And then you also just mentioned it's very difficult from a counterfactual standpoint to examine some of these things. And with respect to the shock of 2020, well, there's a strong view that a recession would have happened anyway. It would not have been the depths of what we experienced. But of course, we had such a government response as well that as violent as the drawdown was in the market and of the economic sudden stop, the degree of medicine provided was so extraordinary as well that we came back. So all these things are pretty unique. You've spent time doing so many different projects from an academic research standpoint. And you've also spent a fair amount of time, you've done some work on the S&P options market. You've done some work with Bob Whaley, whose name is very much attached to the CBOE VIX index. And I'd put that in the realm of implied metrics of what market participants are saying via a price. I was curious if maybe you could provide some overview of your work there, just in terms of derivative securities or option prices.
Sure. So Bob Whaley, early in my career, was a great mentor. We joined Duke University at the same time. Indeed, he was visiting at the University of Chicago. I was a student. I talked to him when I was a student there. And we had a joint interest. So the progression of my research thinking was the following, that the yield curve predicts real economic activity in recessions. So there is predictability in the business cycle, and it's actually pretty substantial predictability. So it's not like a random phenomena. And this got me into my first research stream. And just by the way, I haven't done research on the yield curve in like 30 years. It's something I began with, but I soon moved on. And what I moved on to was the idea that risk premia change through time. And the intuition is really simple, that if you're in a recession, to get people to give up that cash that they really need to invest in the equity market, well, there's got to be a premium for that. And that premium means that the prices are low and the expected returns are high. And the opposite happens in really good times where there's a lot of cash, people are investing in the market, prices go up, and the expected returns are lower. So you get this counter-cyclical sort of phenomena in the risk premia for the market. But this applies not just to a market source of risk, but other sources of risk also. So I got interested in time-varying risk premia. I wrote a paper with Wayne Ferson, and it was called The Variation of Economic Risk Premia. It was published in a top economics journal. If we were publishing that paper today, it would have a different title. It would be called Factor Timing. And that's what that paper was about. And my research with Bob, we actually had to construct a volatility index. And this is before the VIX. And it was a lot of work to do. And indeed, it was so much work that we focused on the S&P 100 rather than the 500, and burned out a number of research assistants actually doing this. But my interest was the predictability of that measure of volatility. And Bob and I published a paper in the Journal of Financial Economics that actually looked at the predictability, because I believed that this was all linked together, that if you think about volatility of the market, it's going to go up in bad times, and in good times, it goes down. So you can see the link of the economic activity, the yield curve, the time varying volatility, all of this kind of coming together. We also had at Duke University, very fortunate to have Tim Bullerslev, the founder of the Garch model. So people were really thinking about time varying risk and time varying expected returns and the implications for portfolio management. So the usual approach, you just kind of optimize your portfolio and let it go. But with these risk measures changing through time, with the expected returns varying, you need to be much more tactical and take that information into account. So that was my early research, I guess, on the volatility of the S&P. And then at some point, Bob continued that research. I pivoted to emerging markets, where I laid my hands on a database of emerging market equities a couple of years before it was going to be released. And I helped them clean the data, but I had access to just amazing data. And I just dropped so many projects and just focused on emerging markets. I figured this is important for me. I've got this opportunity to make an impact in this area. Bob, of course, went on to design the VIX, which is a great achievement. Indeed, I've been very fortunate to co-author with actually two of the founders of the VIX. So Bob Whaley and Sandy Rattray, who was at Goldman at the time, that transformed Bob's original measure into something that was highly viable for trading. So yeah, it's great for me to be in that mix, but it's all very consistent with my research stream at that time.
I started this podcast in 2018, and that was 25 years after the founding of the CBOE VIX. And I had Bob Whaley on just to do a retrospective and talk about the construction of it and the financialization of it as well, which I think is really interesting. This topic of time varying risk premium is fascinating. And in my own area of expertise, which tends to be equity derivatives, I step back and I think about that basic Black-Scholes premise, not only of normally distributed returns, but that volatility is known and constant through time. And one of the things that always strikes me is if you look at the cost of insurance and at the incredibly low end and the incredibly high end, the differential. So I'll throw two numbers at you. In October of 2017, a 1-month straddle on the S&P 500 could be bought for 1.5% of the notional. In October of 2008, by contrast, that same straddle cost about 21%. So it's remarkable how these periods are so different. And I think it does step back to how you characterize it with respect to the business cycle, where when you're in a real down period, you've really got to coax people to part with their money. And so expected returns almost need to be much higher.
Yeah, so that straddle, basically, you can think of it as insurance. So it's a positive convexity sort of payoff. If markets tank, then it's going to do really well. Of course, if markets go up, it's going to do really well. So you're essentially betting on the volatility to increase. And that actually is even related to some of my current research. So I jump from the expected returns to the volatility to the skew. And one of the papers that I'm most proud of, published in the Journal of Finance, basically goes after a footnote in Markowitz's famous portfolio analysis paper and a section that's not really well known. And what he says, and he, of course, is the father of the mean variance frontier and that optimization. So he says, well, this only works if there's no preference for skew. And we know that there is a preference. People like the big positive outcomes and they don't like the big negative outcomes. And we also know that the asset returns are not normally distributed. So my Journal of Finance paper proposed a framework where you optimize over not just the mean and the variance, but you also add the skew. And it kind of makes sense that if you've got a bunch of portfolios that have a similar expected return and volatility, that you want the one that's got the biggest positive skew. So there's direct preferences over that. So again, you can extract information on the ex-ante skew from option prices, just like you can for volatility. All of this really fits together. Indeed, my recent book on strategic risk management, just published a few months ago, that's the theme of the entire book. That when you actually design a portfolio, you need to take positive convexity strategies into account. And it might not be that you're buying a straddle or buying some puts, because that's really expensive to do. But you need to take into account the strategies that provide that positive convexity. For example, time series momentum strategies or factor strategies like quality and profitability. That needs to be taken into account. Even if they don't have the highest expected returns, they actually deliver something dynamically in your portfolio. So you set your portfolio up so that it will be resilient to like a really hard drawdown. And that's the way to do it, rather than having kind of risk management as some afterthought, a tripwire or something like that. It needs to be incorporated all together. And that really is a very similar message to my Journal of Finance paper on skew.
Well, let's dive into your work in your book, Strategic Risk Management. I thought that was really important stuff. And of course, everybody is looking for the hedge that doesn't bleed out so much over time. And as you point to, boy, owning put options or straddles, it certainly works during the crisis periods, but the time in between, which is most of the time, I think you put it at 86% of the time, that vol risk premium really does add up. And so,
minus 14% a year.
Yeah,
so that's totally unrealistic.
Yeah, it's heavy to carry. And so what are we trying to find? We're trying to put together a portfolio that's durable during those inevitable and sometimes very, very sharp drawdowns. And there's only so much that diversification can accomplish. I would love for you to walk through the two areas that I think that your book really dived into most. One is this momentum factor and just the overlay of this strategy and how it, I believe you referenced the equity smile. I thought that was a good description of the results. So why don't we start with momentum and hopefully you can tell our audience just how you think it works, perhaps why it works, and then how to implement it.
So what we're talking about is time series momentum, and that shouldn't be confused with a cross-sectional equity strategy where you sort individual stocks based upon momentum. So think of momentum, like theoretically, as the following phenomena. So as prices are going up, you're buying. And a strategy like that actually resembles a dynamically created synthetic call option, so long call. And then if you think about the momentum when prices are going down, you're actually selling. That's a sell signal. And that actually looks like a long put option. So these time series momentum strategies, and you can work this out theoretically, or you can show it via simulation, create this smile as you refer to. And that's something that is positive convexity. So it is like a long call and a long put. You join them together and you get good performance in downturns and good performance when markets are actually going up. So these strategies, like any strategy like this, that if there isn't much volatility, then the returns will be modest or perhaps a small negative return. And people look at these strategies and say, well, they're not nearly as attractive in terms of expected return than, let's say, just investing in the market. But what they miss is what they actually add to the portfolio in drawdowns. So when the market is tanking, these strategies actually pay off, and quite remarkably so. Indeed, we document this in the book for 7 different major drawdowns. And it's not perfect, but it's not like you're paying 14% a year. You actually, in the non-crisis time, there's a small positive return. So again, it's not as perfect as buying a put option, but it substantially mitigates the downside. So this sort of there are other strategies that have similar properties, but this is a very attractive way to kind of manage the tail for your portfolio. So our book goes through a number of different methods, and this is one of the methods.
Let me ask you this, just with an eye towards market efficiency. We both spent time at University of Chicago. You've got the kind of competing Nobel Prize winners now in terms of how they might explain this, Fama and Thaler. What might the market be leaving on the table here? This is a great asset characteristic. It's got a positive expected return. It's got positive skew, and it introduces exactly the right kind of conditional, I guess, beta offset to a risk asset portfolio. It's very attractive. What do you think is the underpinning of such an attractive characteristic?
So one thing that's really important, this is not without risk. So if you buy the put options, that's without risk. So it's not going to work all the time. That's number one. Number two, this has worked historically. And indeed, our book was largely written before 2020. When March 2020 arose with a major drawdown in the market, we kind of delayed the publication because we wanted to add a chapter to actually look at the out-of-sample performance of these strategies, plus the other things, the other key ideas in the book, volatility targeting and strategic rebalancing. So we wanted to actually use that March of 2020 as an out-of-sample exercise. So that's number one. And number three, actually, yes, we're both from the University of Chicago, but we both fully realize that nobody at the University of Chicago, including Nobel laureate Gene Fama, believes that markets are 100% efficient. Nobody. That's just a theoretical construct. It is true that the US market is much more efficient than, let's say, the stock market of Zimbabwe. That's true. But there will always be situations where there'll be a kind of deviations from the true value. And it's especially challenging because we don't know what the true value actually is. And you mentioned the dueling Nobels, and you're referring to Dick Thaler in particular, the great behavioral economist. And there are plenty of behavioral explanations for momentum, including extrapolative expectations, where you see what's happening that is weighed heavily upon your expectations, and it actually feeds into this momentum phenomena. So there's many different reasons out there. That said, it is still pretty puzzling to me that these strategies continue to do so well. It should be the case that you pay a premium for this type of insurance, but you don't have to. And that's kind of remarkable. In our paper, we're not even using the state-of-the-art CTA-like strategies. We're looking at the past month's return, or past 3 months, or past 12 months. That's really simple stuff. You don't need to have 25 researchers doing that. But the bottom line is that if you think of this as that dynamically created straddle, it makes sense in terms of kind of the theory. And if we layer on some reasonable behavioral assumptions, the fact that it's got like a positive average return overall, that makes a lot of sense too.
Perhaps one area that might concern us about a strategy like this is just the success of it itself, that the sponsorship of it and the sameness with which people might actually implement such a risk management strategy can trip it up. I just remembering back to the quant quake of 2007, where ex post we learned, boy, these portfolios were extremely similar. They may not have been talking to each other each day, a lot of these funds, but they wound up in the same place. And so it was a trapdoor sort of challenge.
Yeah, I think it's different. So what you're talking about is many firms having very similar exposures to factor portfolios, and they were very correlated. And then when something happened that seemed small, it triggered this really high correlation event, and everybody lost money at the same time. So what I'm talking about is, well, suppose you had a portfolio like that, but you also had an allocation to a trend following strategy. If that was the case, then that might have helped you out. These portfolios mainly didn't have that. So they would argue that they had momentum, but it's the different type of momentum. It's the cross-sectional, we call it. So you look at the past performance of individual equities and you form a long-short portfolio. And that portfolio, so that type of momentum has got massive negative skew. It crashes, and we've seen crashes in momentum. Whereas the time series momentum has got this positive skew. So it's fundamentally different. People get that mixed up all the time. And it's still kind of remarkable to me today that more people really don't use the time series momentum. And maybe I understand why, and this is kind of leading to the second contribution of the book, that you talk to, let's say, a giant pension plan, and it's just not feasible for them to allocate to like a managed futures type of strategy that does time series momentum. The market's just way too small. So it's just not feasible. So the second contribution of the book has to do with rebalancing. And rebalancing is something just so natural. Like people think that they understand it, no big deal, everybody does it, it reduces risk because it provides, de facto diversification. And we argue in the book that no, this is the wrong way to look at mechanical rebalancing at the end of the quarter or end of the month. That's an active strategy. And it is a strategy that's got negative convexity. And what do I mean by that? So let me go through the same type of example. Your equities are falling in value. So what do? You actually buy, right, to rebalance. So as they're falling, you're buying. So that actually is like a short put. And then when the equities are going up, you're selling. And that's like a short call. So you've got the exact opposite of what you actually want. And the intuition really clear that if the market is in a free fall, you're buying all the way down. And we show that having a mechanical rebalancing strategy actually increases the severity of drawdown. So it introduces negative skew. So we, in the paper or in the chapter, talk about what to do about that. And one thing that you could do would be to buy, let's say to allocate to a trend following strategy, which seems kind of indirect, but it does do the job. It undoes that negative convexity. It actually makes those drawdowns no less severe than a regular drawdown. But we have this other idea. And the idea is we call strategic rebalancing. And it's a really simple idea. So suppose you're doing monthly rebalancing of your portfolio. It might be a 60-40 portfolio equity bonds. And the market drops very substantially. And you're faced with a rebalance where you're going to buy. So what you do is you actually calculate the trend following signal. And that signal can give you some guidance. So the signal suggests the market will continue to go down. Then delay the rebalancing. So just use the information in the signal to basically time the rebalancing. And then at some point, the signal turns around, and that's when you rebalance. And we show that just using that simple information substantially mitigates these drawdowns. And I mentioned the out-of-sample evidence. The out-of-sample evidence was robust in 2020 with this really simple idea. And again, it's all about convexity and managing that in your portfolio.
That's a great application of something you and others have found in terms of time series momentum, but also in a discipline that most, I would say, especially of the large asset managers, have found it necessary to do. So adding alpha to the rebalancing process, that's really interesting. As you mentioned this word convexity, I was hoping you could talk a little bit about what you found in terms of vol targeting. And I think you spent a little bit of time discussing some of the similarities between the time series momentum factor and vol targeting. Vol targeting is certainly a discipline that folks have utilized more and more. It gets a lot of press in the derivative space as imposing systematic buying and selling into the market, mechanical buying and selling. And there's a host of folks that jump up and down each time the market gets volatile and, are convinced that there's X $100 billion of S&P to buy if this happens or that happens. And it's quite interesting to see the overlay of this vol targeting and how at least it might impact the direction of the S&P. I was hoping you could walk through your work there.
Sure. So this is a chapter in our book where we focus on volatility targeting. So the idea of volatility targeting is not new to us. Indeed, the basic idea, the foundation of the idea goes way back to the late Fisher Black. So the idea is with risky assets that there could be some improvement in expected returns by scaling the returns by volatility. So think of the situation where market returns are going down, and that mechanically increases the leverage of companies. So just by almost definition, your debt equity ratio, if the market's going down, that ratio is going up and increases the riskiness. So we see that volatility also increases at the same time. So the idea here is that when volatility increases for your equity portfolio, you reduce the exposure. And that's the fundamental idea of vol targeting. And of course, if the volatility goes down really low, you increase the exposure. And what we do in our paper, we do a number of things, but we look at different asset classes. And people blindly apply vol targeting to just about everything. And it turns out that it works nicely in risky securities like equity, credit, things like that, but it is not recommended for fixed income. Indeed, there isn't that economic story to tell that I just told you about the debt equity ratio for fixed income. And actually, targeting of volatility in fixed income could actually lead to lower returns. So we kind of go through that, and we also relate it to positive convexity strategies, like the theme of the book. And if you think about what's happening, the market's going down, volatility is increasing, you are reducing your equity exposure. Oh, well, that sounds like the dynamic replication of a put option, right? Very similar to what a momentum strategy would be doing. Indeed, there's a strong correlation between the returns and the volatility for equities. So again, I will tell you that the out of sample evidence in March 2020, that volatility targeting was incredibly helpful in reducing the size of the drawdown. It got you out of the market at the right time, and you got back into the market at the right time. So it works really well. So it works really well, but people criticize it because it potentially could increase market volatility. So think of this, that the market's going down, that triggers many different companies to basically reduce risk, which means dump equity. So when the market's going down, you dump equity. And the same sort of criticism is leveled at the trend following people because it's the same trade. So the idea is that this might push markets down in a cascading type of effect well below where the prices should actually go. So what do I think of that? I think that criticism is a pretty weak criticism. And the reason is that there's somebody on the other side too. And on the other side is the value investors. And value as a strategy, I've also studied this in a recent paper this year in the Financial Analyst Journal. That strategy has got an amazing record through time. And essentially, if it's the case that if these vol targeting strategies or the momentum strategies push the market beyond where many people that are studying it think is reasonable, then the other side comes in. And to think that this somehow induces some fundamental inefficiency, I think is really misplaced. I just don't buy it at all.
This is where I was going before with the kind of overlay of these strategies on the market. They are effectively introducing a kind of a short gamma element to the market. It's difficult to know, I think, very difficult to actually calculate, really understand how much of this is out there. I think one firm's vol targeting scheme is actually going to look different in terms of the recency of realized vol that they utilize, perhaps the caps that they utilized and how quickly they scale in or scale out. So it's not homogenous, I think, is one of the things that I've come to understand. You also mentioned value, which I think oftentimes is linked to momentum as sort of its anti-cousin in some ways, both sources of return. And I guess this is more on the cross-sectional aspect than the time series aspect. I'd love to hear, you mentioned some of the work that you've done on value, and that's just been such an interesting area. And of course, you're tied as a partner into Research Affiliates. They've done a lot of work on this. I'd love to hear what you've learned and what you've written recently.
I've been just extraordinarily lucky to have association with these high quality firms. The book is written with Otto and Sandy from Man Group. I've also got this research stream with Rob Arnott and co-authors at Research Affiliates. It's just, for an academic, I get so many ideas by interacting with practitioners, either at these companies or when you actually go out and talk to the asset allocators. And basically, you're there to listen and maybe help them with some of the questions, but you learn what the most important questions actually are. You know, for example, there might be a question on, trend following hasn't really done that well in the past few years. And we get this question, let's say 2019 or 2018, and that was a fact. So should we deallocate? And then to actually kind of work through the logic of, you're just paying the insurance premium right now. And then when the crisis hits, you're going to get it all back and more. But another common question is, what about value? For many years, like over a decade, it underperformed. And the question obviously is value dead? And value has got a long history, goes back to Graham and Dodd. So this is not a short history. It's got theoretical foundation in terms of values directly linked to expected returns in our academic models. And it's also got kind of a behavioral foundation. And the best way for me to describe this is one of the ideas of Rob Arnott. And that is, if you do a market cap weighting portfolio and make the assumption, which is a reasonable assumption, that there is some mispricing out there. In the US market, it might not be much, but let's say on average it's about 2%, which wouldn't be unreasonable. So if you do market cap weighting, then by construction, you are essentially overweighting overvalued stocks and underweighting undervalued stocks by construction. And that's the basic idea of value. So value is telling you two things. Value is telling you something about risk, and that's where it's linked in our asset pricing models. But it's also telling you about misvaluation. And you need to be careful with value to separate those two. Like, there is a reason that the Russian stock market is cheap by any value measure. It's because it's risky. It's not necessarily undervalued. It might be undervalued, but it is risky. So you need to take that into account. So my paper in the January Financial Analyst Journal was called Reports of Value's Death May Be Greatly Exaggerated. And the timing just couldn't have been more perfect. And what we did, our historical analysis, we looked at that most recent drawdown, and then we looked at the source of the value premium and saw that the basic sources remained robust, and that it was just a situation where, think of this as the value of the value portfolio was just at like an extreme. It was at the 99.9th percentile. And if there was any reversion, that it would lead to very substantial returns. And that's exactly what's happened recently, that there has been some reversion. So the actual mechanics of that premium are really interesting to go through. And a lot of it has to do with just the migration of stocks. So you sort your universe into a portfolio of the really cheap stocks, which are long, and the really expensive stocks, which are short. And some of the stocks in that expensive portfolio will drop out. Well, that leads to a positive return because you're short. They're dropping in value and you're short. And then there's some stocks in the long portfolio of the cheap stocks that move out of that portfolio. They move up. And you're benefiting from that mechanically. So this kind of migration of stocks is a driver that we looked at through the entire history and noticed that it was resilient over the last decade or so. And there's just no reason that that would actually go away. So when you look at the fundamental drivers of value, we concluded that there was nothing that was unusual. The only thing that was unusual was the value of value, and that could revert. We didn't say when it was going to revert. It just so happened that we published the paper and it started reverting pretty well immediately. So that may be some good luck on our part. But I think that's the right way to do it in quantitative research, to go and look at the theoretical underpinnings and look at the drivers of the premia and try to understand the drivers and figure out if there's something that's happened structurally to change those drivers. And the answer was no.
Well, this is a really interesting question. And as you say, the value of value, we had gone through that period where perhaps the value factor was in the 1 percentile of its value. So at an extreme. And of course, when things get to an extreme and they stay that way, they really do test our patience. And we're just apt to want to find explanations, especially when they get to extreme levels for long periods of time. But I think I know the answer here, especially just given your work with Rob Arnott, just on this notion of time variation in factors, and that you can't be agnostic to the value of different factors, that they become more or less attractive over time. You can't simply be agnostic to price. I was hoping you could maybe share some of your thoughts on that.
So this comes full circle in our conversation, because remember, we started with my early research paper on factor timing. So this is really what you're talking about. So you could look at many different factors and actually measure how rich or cheap they actually are on a value basis. And that's going to give you important information on how much you allocate to those factors. You can also look at the momentum of those factors, the time series momentum of the individual factors. That's going to give you information about how you allocate to these factors. So it doesn't make sense to me that you would want to ignore that information. And people say, well, factor timing is really hard. It's hard to just identify the factors. Well, I totally agree with that it's hard to identify the factors and it's hard to time the factors. And it's very difficult. But that's why people in finance get paid a lot. So you're paying your asset manager a generous fee, and you expect them to look at all of the information, optimize that information, and do better than a manager that completely ignores that information. So I'm all for active management of factor exposures. There's some low-hanging fruit that's available out there to assist with the dynamic allocation to factors. Yes, it's hard, but you have to do it.
Well, in the time that we have left, let's pivot to some of your work on DeFi. You're out with a book on that as well. Love to hear how you got interested and just some of what you've published in terms of this new research.
Yeah, so this is mainly based upon my teaching. So I impact the practice of finance with my research, talking to investors, talking to you, interacting with asset management firms, but also my teaching. So for the past 7 years, I've been teaching a blockchain technology course, and a large part of that course was focused on decentralized finance. And now that course is 100% decentralized finance. Decentralized finance is where, think about the way we trade today, usually through a broker. It might be a fintech broker, but it's a broker. Decentralized finance, think about trading with an algorithm. So you send asset 1 to the algorithm, it sends you asset 2. The algorithm's available 24/7. It's completely transparent. You can see exactly what's in it in terms of balances, and you've got a good idea of the price that you're going to get. And it happens instantly. The execution and the settlement are the same time. So it's not too hard to imagine in the future, we're going to be interacting with algorithms, and not just in finance. But when you have this trading capability, it effectively eliminates the need for all of the middle people. So the centralized exchanges, those are eliminated. And just to be clear here, when I talk about a centralized exchange, we think of these crypto exchanges like Binance or Coinbase. Those are centralized exchange. So DeFi is not about centralized exchange, it's about decentralized. So with algorithm, and then DeFi also has savings platforms, it's got lending platforms. Again, it's algorithmic. So there's no brick and mortar, there's no middle office or back office, there's no profit motive of a corporation. It's just completely different. And then the last part of DeFi is tokenization, where I actually believe that everything in the future will be tokenized. So we think of tokens today as cryptocurrencies, but more and more people are opening up to the idea of tokenizing other things, like these NFTs, where a piece of art is tokenized. And I think it's a really powerful idea. You put all of this together, decentralized finance is something that is fundamentally democratic. So everybody is treated equally. It's a technology of inclusion, and you don't need to have a bank. Your mobile phone is effectively your bank, and you're operational. Everything is open. So remember I said that for a decentralized exchange, you can see the code. You can see the balances. Everything is open, where our current financial system is very opaque. It'll be very interesting to see. So this area is largely unregulated right now. We don't know what to do, creates uncertainty, but it is a global idea. In 15 years, the financial system will have essentially no resemblance of the system that we're in right now. That the current financial system really hasn't changed over the last 100 years. The same banks, the same exchanges, the same brokers, same insurance companies, maybe some different names. Maybe we'll layer on some digitization, but nothing's really changed. And there's a limitation as to how far you can go with this. We will be trading with algorithms. I don't think it's an outlandish prediction. If you think about it, it's logical.
It's going to be fascinating to watch this evolution. Is probably not the right word because it does seem like it's happening at a pretty feverish pace. And when you make a prediction of 15 years, that's really a blink of an eye. So it's going to be really interesting to watch and going to give you more and more to look at and think about and write about. So Campbell, it's been a real pleasure to spend an hour with you and to learn more about your research and to deliver it to our listeners here. I really appreciate you spending the time.
It was great that you invited me. I enjoyed the conversation.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.